With our stable business and regulatory environment, skilled, creative and enterprising workforce, and our open economy, Australia attracts investors from all over the world. Our proactive management of the COVID-19 pandemic, our safe communities, and our high standard of living make us an even more attractive place to invest in these turbulent times. What does foreign investment bring to Australia? Technology and know-how are the bedrocks of the Australian economy, supporting 1 in 10 jobs, supplementing our domestic savings, and bringing us new technology and innovations. As Australia recovers from the shock of COVID-19, foreign investment will help us create new industries and new jobs to drive economic growth and ensure that Australians continue to prosper. Investment has always been a part of the Australian success story. It made us the home of the world's largest lithium-ion battery, the developer of the first needle-free vaccine for the Zika virus, a world leader in solar power farms, and a first mover in the circular economy with projects from Perth to the Latrobe Valley, turning waste into energy. From Townsville to Kangaroo Valley, we have seen foreign investment reinvigorate communities, while venture capital from overseas revs up our startups so they can take on the world. It's not just new investment. Many international companies are reinvesting in Australia, doubling down on their initial commitments because they have learned that Australia always delivers. Investment is a key contributor to the Australia we all want, a nation with a high-tech workforce, with industries of the future and opportunities for young and old, a stable and prosperous nation with the capital and innovation to make the most of our resources.
Hello and welcome to all of you. We've had a wonderful webinar series, Property 5.0, and we are into the final webinar. I really wanted to welcome our guests who we've got today. So we've got Jason Eggleton, we've got David Hume, and we've got Paul Niederer. And what we're going to be talking about today is we're going to be wrapping it up. We have had a webinar on co-living. We've had a webinar on green energy and ESG. We've had a webinar on diversification. And today is a wrapping it up and looking at it holistically with regards to Australia, with regards to Brisbane, with regards to the market, and even with regards to the opportunity. So welcome to all three of you. It's wonderful to have you online, and I'm very excited to share with everyone the information that's happening on the ground with regards to the Australian economy and the Australian property market. So let's rock and roll. Do me a favor. It's always good to know where people come from. So in your chat box, just let us know where you're coming in from. Always valuable to know where everyone's coming from. Jason, I can't remember exactly where you are. I know David's in Sydney and Paul's in Brisbane, but where are you based at the moment?
I'm in Sydney as well. I'm in the beautiful suburb of Manly, beachside suburb, 18 minutes from the city, 10,000 miles from anywhere else. It's perfect. Sun, surf, beach, but at the moment it's been raining. So most of the time it's pretty good. Manly.
Excellent. Okay, so we've got 3 people on the ground in Australia, which will give us good context of what's happening in the Australian market. And to those of you joining us, let us know where you're coming from. I want to recap a couple of the things that I think are important. However, I will say that the idea today is to have a Q&A conversation. So I'm going to share some slides with you quickly, and these slides will be available. So if you want to watch the, if you want this pitch, this PowerPoint, then we'll make them available, because the idea today is not to go in and actually spend all the time. But if you look, there's a great article here, which is built by the Australian government, and it talks about the growth of the Australian market. It talks about where the economy is going, where the economies come from, and what their different accelerators are. I'm not going to road read it for you because you can literally read it for yourself, how they want to turbocharge the economy. What I do think is important is these stats here. So Australia is the 13th largest economy in the world, a $2 trillion economy, and 1.6% of the global economy. What I think is also important is that when you look at Australia, it has outperformed any of the other countries in the G7 with regards to what has happened since COVID, which is really important. And then finally, they've got their perspectives on how they're going to continue growing as they go into it. So this article is linked below here. And as I said, this is a key component. When one's looking at investing, one always has to start at a macro level. You have to look at where the strongest economies are, And then you get down into a more micro level in terms of regional economies, city economies, and ultimately down to opportunities. When one looks at what's happened in terms of the economy since COVID, our economy remains strong, its fundamentals remain sound, and once again, it has proven a remarkable resilience. Just by the way, in the last crash, so I'm talking 2008, 2009, Australia had the best performing property market in the G20. So a very resilient economy during tough times. And I've already shown you this. With regards to the market as a whole, again, I think this is quite important. So this is the research documents here. So again, I'm going to share it with you. There's a website called CoreLogic that I would suggest that you go and check it out if you want all the information that is happening. And there's a whole bunch of articles that are here. And let me just go back to the PowerPoint, because again, I'm not going to go into it, but I just took out some key points. Firstly, the smaller cities are driving the growth over Sydney and Melbourne. And you can actually see here that Brisbane is the #1 city that is driving growth at the moment. Then in terms of rental markets, I know that Jason and David, you want to talk to this because of what's been happening in terms of the rental market growth, not only just in Brisbane and Queensland, but across the whole of Australia. So we'll come back to that. Then something we're also going to touch on is the floods and the impact of floods and weather diversity, etc. Again, there's a whole article on it if people want to go and read. I will point out something that I think is very relevant. Which one is it? Yep, here it is. Yep. And again, what's great about Australia is that there's a huge amount of research. So whenever you want to look at about where markets are going in the future, it's always useful to look back. And the last time they had a big flood was in 2011. And there's a whole bunch of research as to what happened then and what is happening now. Then with regards to, what's happened? With regards to interest rates, RBA, which is effectively the government bank, remains patient, waiting on more evidence of wages growth and sustainability of inflation outcome before lifting rates. So rates are remaining stable. And then this is something else that we're going to talk about today, which is affordability. So if you want to go and read a affordability report that was done by CoreLogic and by ANZ, you can read all about it. Again, my understanding, Jason, we're going to talk about this anyway, but if people want to go and get all the research, they can actually do that. And then finally, this is the CoreLogic report for the best of 2021. Again, I've given you the place that you can go to get the report. I'm not going to, again, read all the different areas and what's been happening. But if you look through here, in terms of these different articles, you can see what's happening in terms of, and just by the way, look at the change of supply in Brisbane. There's like such a problem in terms of supply, and we're going to talk about demand versus supply now. And this is the rental market we've discussed, RBA we've discussed. This is the report that you can download, the housing report. And then, sorry, these are the full reports if you want to go and get all the information. So I've learned one thing in life: when investing, you've got to get the right information and you've got to have the right partners. But without further ado, I don't want to take you through all the reports. I just wanted to show you where you can get the best information. What I think you're going to do is learn a lot more from our partners on the ground, because this is what they actually specialize in. Before we move to those partners, I just wanted to share with you two more documents which I think are relevant. One is what's happening in Brisbane, and the fact that Brisbane is actually outperforming any other market in the country at the moment in terms of capital growth. And then something else that's really relevant, and maybe we can talk to this now while we've got it up. And Paul, I mean, you're actually based in Brisbane. Brisbane's due to get the Olympics in 2032, and it's going to have a significant impact on not just Brisbane, but the whole of Queensland. And when one looks back at what happened in Sydney in the last Olympics, and I think Sydney was 2000, is that correct? Was it the 2000 Olympics? And it had a massive impact on property prices. Could we maybe just start here, you know, David, Paul, or Jason, around your thoughts on the Brisbane Olympics? We'll come back to the overall property market because there's a lot to discuss there. But while we've got this slide up, let's just touch on the Olympics.
Yeah, look, I think the Brisbane Olympics is fantastic. It's there's a couple of things that are really coming out of it, and One is it's really launching Brisbane onto the world stage. We've had 2 Olympics previously, which have been held in Melbourne and also in Sydney. Melbourne was in 1956 and Sydney was in 2000. As far as the Olympics go for Brisbane, KPMG did a study on this, and they've come up with there's economic and social benefits of around $8 billion for the Queensland economy. It's larger nationwide, but for the Queensland economy, it's $8 billion, which largely is for Brisbane. And if you look at that, and as you've got in one line there, a rule of thumb on infrastructure spend of $1 billion leads to a big property boom or rental surge. And so when you've got an $8 billion spend that's coming up and that's actually happening, it very much leads to a huge pressure on it, and you'll find a rental explosion is really what's going to happen over the period of time. Yeah.
And the biggest driver for that, David, is workers, right? Workers coming in, they're going to be short-term interim workers, fly in, fly out. They're going to be there while they're doing infrastructure work like tunnelling, putting in train tracks, putting in major infrastructure buildings, hospitals.
Yeah,
so quite a transient workforce for the next decade.
Yeah, I think what they're talking about is an additional 91,600 full-time equivalent jobs in Queensland and more than 122,000 nationally. That's just going to be caused from the Olympics itself. So, for a country of our size, that's massive, absolutely massive.
And David, do you think, like recently because of COVID, we've had an exodus of migration from places like Melbourne to Brisbane, which has really pushed the Brisbane property market up, especially in the owner-occupying housing market. Do you think the impetus of the Olympics is going to add to that and fuel the prices higher over time, especially with the shortage of stock?
Yeah, look, it's got to. At the end of the day, what is it? The current population growth is forecast to increase. It's currently running at about 1.9%, and it's forecast to increase above that every year. Is where it's at. So, when you've got an existing, if you like, we've got. I don't know. Can I actually share? I've actually got an image here of which I've actually taken off. Whoop, where's it gone? Actually, I've got the wrong one up. Hang on, 2 seconds. There it is. Share my screen. Just, are you able to disable the?
Oh, hang on. Have we got that problem again?
Yeah.
Hang on 2 seconds.
Just
allow
multiple.
It'd be interesting to see what it says, David, because I know initially at the time of COVID, when COVID first started in 2020, rents declined because we lost a lot of students and skilled workers. And then over the last 2 years, the rents have been going up. I think initially when we were looking at certain suburbs, we had quite a relatively high vacancy rate, which is now gone from 4% down to 1% in some places.
Just while you're pulling that up, David, just for all the attendees, the whole idea is I've tried to set a bit of precedent. I've given you some graphs, etc. We're now moving into a Q&A. If you've got questions, please jump in. We're going to be kind of jumping through some of the major topics that we've been discussing over the last couple of weeks. So put any questions that you want either into the chat box or the Q&A. Sorry, back to you, David.
So what I've got here is, can you actually see that? I'll try and zoom it up a bit bigger. Can you guys see that?
Yep.
Anyway, so what it is, this is a set of slides. It's taken from SQM research. If you get online and you Google SQM research, there's a whole bunch of charts that you can actually get access to. And they include, these ones are free. They put them out on a monthly basis. And what it's actually showing, what these charts are showing, is that this is at Chermside, the postcode for Chermside. The current vacancy factor, I don't know if you can quite see that, but it's, I'll try and zoom in.
Chermside's in Brisbane.
So Chermside's in Brisbane. Which is I'll just take, so effectively it's actually sitting at about 0.8% vacancy, which is obviously very, very, very low. And this has gone down. So it's been the vacancy hasn't just happened because of like the pressure hasn't been happening just because of COVID. It's actually been in steadily reduction in vacancy since 2017, which has been an absorption of the market, what products on the market. And so, as you can see, this is rental listings, and they're only on, it's on the market, and basically it comes onto the market, goes off the market. So this is under 30 days that most of the rental properties on the market. And as you can see, there is pressure on rental prices are increasing, and that isn't just on Chermside. That's also across Brisbane in general. So it's exactly the same thing. So I thought that's worth sharing. If you're actually interested in those sorts of stats, you can get on and have a look at SQM research.
I think that's really.
Sorry, after you, Jason.
No, after you, Scott.
No, I was going to ask that PowerPoint, David. Is there any way? Is that a separate PowerPoint, or is that something that we could make available?
Yeah, look. I can give you. I can share that. I can share that PowerPoint with you. It's just basically it actually talks more. This one was one that we did the end of last year, and it talks more about the Olympics. Look, one of the key things, why I was getting to that is when you at the end of the day, we've got a whole lot of factors which are building up on and putting pressure on it. So you've got to look at the broader factors. You've got to look at with regards to demand and how things are going, and what factor the Olympics will play is, how that will influence the property market, and I guess it depends on what's happening on the broader economy at the time. Things like credit and monetary policy, local housing supply, political stability, and the broader local economic conditions. So what I've tried to show you is that at the moment, the housing supply, there is an undersupply, there is a significant demand, and all that the Olympics is going to do with that massive infrastructure spend is going to add to the demand that's already there.
I think, David, that we're going to get more migration to Brisbane from the other cities because of affordability. I think also there's more employment in Brisbane because of the infrastructure. So I can definitely see some form of city migration from Sydney and Melbourne to Brisbane, which of course will then put pressure on house prices and rents. But it's a good thing in a lot of ways.
Yeah, I mean, I think what I'd like to do is just take a bit of a helicopter view out. I've tried to give some articles. What I'd like to ask, just from the three of you, I mean, we started off with, call it the Australian economy, and I'd like to kind of do it in three stages. So we've got the Australian economy, the Australian property market, and then kind of call it the Brisbane property market. And I know, David, even down to Chermside and like why the area, it's almost like any investor should be looking at it in a funnel, top to bottom. And as I've given kind of the market research, I mean, anyone that's got Google can find what I've found. I've just made it easy for people to get it in one place. But is there anything on the ground? I mean, you guys all live there. Anything on the ground that is relevant at the moment in terms of the Australian economy?
I think the thing that surprises me most, which is going into the stages of COVID, we all thought that we'd have massive unemployment. We thought unemployment would spike. In fact, it's done the reverse. We now have the lowest unemployment we've had for decades. It's like at 3%, 3.5%. Our GDP's up. Our economy is doing really, really well compared to other countries globally. Our dollar's still relatively strong. We've still got really good commodity sales. Commodity prices going through the roof. So that's helping us on a federal level. I think as a country, we're in a really good position globally. And our economy's strong, our property market's strong. The expats coming back from overseas have pushed the property prices for owner-occupiers up. We thought prior to COVID, our property prices were quite high, especially in apartments, because we were getting a lot of investors coming in from overseas. And then it switched at around about 2020, and we started to see the increase in owner-occupied dwellings, especially with people migrating Melbourne to Brisbane, Sydney to Brisbane, expats coming back to Sydney wanting to live in certain locations. So it's had a strong impact on our property sector. So I guess Australia's doing pretty well. It's a pretty good, safe country.
Yeah, and look, we do have an affordability issue on housing. It's interesting with it. We're due to have a federal election, which is going to be called any day now. I smile about it because they've been saying that it'll be called any day for about the last 2 months, but our Prime Minister hasn't got round to calling it yet. But one of the key things which Scott's got up here is affordability. The affordability of housing is right up there as a key issue, and it's how how people can get themselves into property, be it rent or be it purchase at an affordable price. It's a major issue in our country.
It's quite interesting. Let's just talk a little bit about this affordability, because there's a number of things here that I think are relevant. And Jason, you were giving us, before we started, some stats on people moving in and supply and demand. And the problem with supply and demand is that if there's more demand than there's supply, then property prices go up and so do rents, which leads to affordability. Now, most major cities in the world have affordability issues, but Australia, in comparison with most other first world countries, actually is, quite frankly, a lot worse than almost anywhere else. And, it's hard to, when you say it's the number one thing coming up with elections, like, what does that mean? And more importantly, how do they solve it? Because the demand keeps outstripping the supply,
There's a government organisation called NIFIC, which stands for National Housing Finance and Investment Corporation, NIFIC. NHFIC. NIFIC was created as a bond aggregate to invest with what we call community housing providers or organisations to build and maintain affordable accommodation. Now, there's a difference between affordable and social. They have to make that quite clear. Affordable is basically key worker accommodation, and it's designed to make properties affordable for people to live in closer into the CBD in locations where they work. So fireys, nurses, orderlies, teachers, etc. So NIFIC just released a report on the 25th of March, which was the National Housing Report. In that, it earmarked the upcoming strain on the housing supply. And what their report has indicated to the government is basically for the next decade, nationally, we're going to have 20,000 dwelling shortfall every year. So no matter how many properties we build and what's in the pipeline, we're still going to have a shortage of at least 20,000 properties per year. So in a decade, that's 200,000 homes that we need from today, right? Just to be even, not an oversupply, but an undersupply. So what they've put in their report is they're trying to make the process of delivery easier. logistics, supply chains, building. We need more people. We need more people working in the industry to deliver these properties. We need easier programs by councils and governments to approve new developments. So given that they are the national body and they are fairly in tune with what's happening nationally, we can see that this problem isn't going to go away. So what that will do to the housing market is the twofold thing. Undersupply of property, prices go up, rents go up. Prices go up, rents go up. The more supply we have, prices come down and rents will stabilise. So we know for the next decade, at least, any investment in the property sector is going to do well. Pretty simple.
And I think if you look here, Jason, in this report, it talks about the household income ratio. So effectively, it's how expensive is a house compared to income. And it continues to go up. And it's actually talking in this report how they thought COVID would bring it back down, but it's gone the other way. And
yes.
So talk to us a little bit. You know, one of the sectors that Paul and I discovered, 10 plus years ago was the whole medical sector. And, the whole co-living sector is something that's becoming really exciting around the world. And in my understanding of it is that the number one driver that drives co-living, and again, I could be wrong, but this is my understanding, is one of them is affordability. And just talk to us how co-living and the asset class of co-living can start to mitigate or solve some of these affordability issues.
So sometimes in Australia, we get preconceived with affordability being the direction of purchasing, owning your own property. But affordability also takes the sector of renting. What's affordable? NIFIC again dictates that at least 1/3 of your weekly income should go towards your rent. And they have a whole system behind what they define as affordable and what people can pay for rents. So if we look at what's affordable, why co-living is an amazing sector, why build to rent is an amazing sector and a new sector. We started to see this increase in prices in around about 2015 when we started to get offshore investment into the country, into residential apartments. What we saw was a need then for rental accommodation. People, again, supply and demand, rents were going through the roof. 1 bedroom, 2 bedroom units were being shared by 5, 6 people sometimes for a 2 bedroom unit, just so they could get the affordability down to a responsible level. With co-living, what we're doing is we're taking basically the building envelope, increasing the amount of occupants within the envelope, but reducing the rent on a $1 per room basis. So we get more people in, which means that therefore we can charge an affordable rent for the occupant, but for the investor, we actually make more money per square metre than we would if we did traditional apartments. Yeah. So the good thing is for the tenant, it's a lot more affordable. It's an inclusive rent. It covers their electricity, gas, Wi-Fi, furniture, because we produce a furnished apartment. And for us as the owner or for the investor, it means that every dollar that person spends, the investor's actually getting more per dollar on return on their money. It's a growing market. Since 2016, it went from about a couple $100 million worth of assets to now over $8 billion and growing rapidly globally.
I mean,
what are your thoughts, David?
Yeah. So it is an emerging asset class. It is in Australia, but it is if you like, more of an established asset class in the UK, America, up around Asia. And one of the key things that you've got to remember with co-living, it actually provides a community, and it provides a community for people. So whilst we're getting more people into a building because of the size of it, there's also a lot more communal features within the building that people have to enjoy as part of what they're living in. And the age demographic, which is typically your 18 to 35s, even though we're getting, people up into their 50s and beyond, living in these as well, or living within the facilities as well. It's very much targeted at people who want to have a good quality. Like we are, like the co-living, the purpose-built co-living is a very good quality form of accommodation, but at a more affordable price, as Jason was saying. But and it's got good amenity, and you've got an immediate community if you've moved into an area as well.
I think we were reading during some mental health articles about co-living and how it was attributed to creating good mental health with the guests and the tenants because of that collaborative nature. So there's some strong evidence for the wellness of living together in a supportive community.
It's quite interesting you say that, Jason, because when I first started looking into co-living, and obviously COVID came along, and my initial reaction was, well, co-living doesn't make sense. People don't want to live together with, and all catch COVID together. And and actually it was the complete opposite. In big markets like Europe, in the UK, America, people actually flocked towards co-living because they could live within a community and not be isolated in a home or a flat. So it was interesting how one's perspective and the reality were two different things. Jay says here, the spectrum of co-living variations and potential in the university towns is impressive. 2 years ago in New York, co-living was practically non-existent according to popular models. So that's someone coming from America. And this is an article that I know you guys shared with us, where there's a co-living skyscraper in Sydney now. And it actually, funny enough, it talks all about what you were just talking about around the lifestyle and why people, this is more from a tenant perspective, but why they want it. Why do they want to participate in it? Why do they want to be involved in it? Again, this article is in the PowerPoint. You can go and Google it if you want, but it's just really interesting, where it talks a lot about what people want, who the rental market is, and actually, funny enough, talks a lot to that affordability that we were just discussing as well, which I think is really key. So talk to me a little bit, Jason, because you mentioned something else that I think is really important. And, institutional investors have been participating in this space for a while. What I tend to refer to as middle-class investors, they tend to go out and they buy houses or apartments. I mean, that's basically what we've all been indoctrinated to do for, decades. And yet the institutional investors don't. If they go into residential, they do it at scale. In America, they call it multifamily. You refer to it as build to rent. And really what's interesting is when you look at the returns, and I've been helping people invest in Australia since 2008, the average return if you're buying a house, net return or apartment, is often 2, 3, maybe 4% tops. I'm talking net rental return. And yet the institutional players go in because they can do it at scale, they can get access to institutional opportunities. And you had some interesting stats around build to rent and why this is exciting now for investors to be able to participate.
Yeah, there was a report done recently by Carter Keck Kramer out of Melbourne. And it's the first time that an organisation has really looked at the build to rent or multifamily sector in Australia. And because it's a fledgling asset class here, right? But it's taking off rapidly. And what they found in their research was when they compared a traditional build to sell rented property. So that's a mum and dad comes in and buys an apartment and rents it across the road, say from a multifamily asset class. They realized that the multifamily asset class was achieving a rental of 20% or higher, more than the apartment across the road. Right? So why is that? That's because they're a curated community. They have, like we do in our co-living, co-working spaces, relaxation spaces, gardens. It's designed to have that community aspect, and it's designed with the facilities that brings. Whereas the traditional build to sell apartment block doesn't. It doesn't give you those facilities. So that's one interesting factor. Now, predominantly in Australia, all major build to rent multifamily developments are done by corporates. Now, we've got a lot of companies coming out into the States, from the States, like Greystar, etc., who are already in the space, participating. And we have local participants, development companies like Grocon and Mirvac in the build to rent space. The good thing about what we're providing is we're kind of like a niche market in the build to rent space. And we're giving the opportunity for the mum and dad investors, the family offices, to be able to use the increased revenue stream that this provides and get in at the ground roots level. So what that means is they can have the benefits that a corporation does, or a sovereign wealth fund does, or a superannuation fund does, get the higher return on their equity and be part of a larger picture. Yeah? As opposed to, like, I smiled a bit when you said people get 2, 3, 4% off a residential property. Because I can tell you in Sydney at the moment, if you were to go and buy an investment property today, your net would be about 1.7.
Well, I think this is my point, is that people, you know, and again, I've done it and I've helped hundreds of investors do it. And, you know, they often get caught up in, yes, but I'm getting capital growth. And I go, okay, but, you know, really wise investors know that you've got to balance capital growth and income. And so when you talk about a 20% higher income, etc., it becomes really meaningful and really important. And again, they always say, if you want to be wealthy, do what wealthy people are doing. There's a reason institutions are in this sector and not buying houses or apartments, you know.
Yeah. And it's pretty simple, right? So it was $500 a week, it's now $600. Right? That's so $5,000 extra a year.
So let's go to the next thing that I think is relevant. And before we go to the floods, let's talk about green and ESG, because, you know, before we talk about the problem, let's focus on the solution first. And you know, what's quite interesting for me is that, you know, it's so interesting what is happening in Australia. I mean, and again, around the whole world, we know that. But, you know, the floods have recently happened. But what I wanted to talk about before we go to the floods was the solution. And around the world, you've got, you know, problems with sustainability, you've got ESG, you've got green living. And I know that we've been helping people invest for a very long time. And a lot of people are asking us now about green investing. And just to be clear, we did an entire webinar on co-living. So we're not trying to redo that. Like, we did it with all the stats and everything. You can watch the recording. We did a webinar on green where David and Jason actually brought in experts in the space. And so if you want to go and watch that, I'd highly recommend. There's an entire webinar on that. So we're not trying to redo that webinar. But I do want to just touch like some of the highlighted key points here. Again, Jason, you spoke earlier about how ESG is becoming such an important factor, and how, you know, green investing is not only important just to make a return, because you can actually make a above average return, but it's also good for the environment.
Yeah. So it's fascinating. If you're an EY now, or any of the larger advisory firms, they have specific ESG divisions. And those divisions are advising their corporate clients and their family offices on how to invest sustainably in sustainable products, right? And there's a lot of mandates now from all these corporations that they have to have an ESG component into their investment strategy. You know, globally, we're finally understanding the need to be socially and environmentally responsible. And Dave and I have both been in the development field for 30 years. You know, and we've seen the changes happen over those 30 years. And I think now finally, governments and the end occupant or purchaser is requiring that we have this for the planet.
Yeah, and what's actually really helping us as developers and operators of these facilities is that you know, the governments are helping provide incentives for us as developers and operators to actually be able to implement this and include this within the developments, because they do recognise that it's there's additional cost that goes in for this. But on top of that, we're able to actually look at it because we are actually hanging on to it. We're actually able to look at it from a life cycle costing perspective. So it isn't just throwing money at it. We're able to look at these things pragmatically to be able to get this stuff to work and to work financially. But one of the key things is also the financiers. The financiers are actually wanting to be involved with socially responsible investments, and so they're actually there's a number of lenders out there that are recognising that and providing a discounted rate or to be able to to when you're actually securing your senior debt for a facility. So it's starting to happen. We're seeing it in different asset or different asset classes, and we're seeing it in different size developments, and it will become more and more normal. And so we're in this for the long haul. And so as we've said, we're wanting to set up, and I'm not going to go into detail, but we're basically setting up a portfolio of co-living buildings, but the target is for them to be carbon neutral from day one of opening. And that's a benefit for it's a benefit for the people living there. It's a benefit for the investors because we're future-proofing the investments, and it's a benefit for the community because we're reducing the carbon footprint of those buildings and the people within those buildings.
So I think our initial cost is slightly more, but the return is a lot higher, David, isn't it? When you look at the actual running cost of the building, it's actually more economically viable over the longer term for the running cost of the building.
That's it. So we're able to offset it against the operational the OPEX or the operational costs is really what it needs to come down to. And also, if we're smart about it, we can also offset it against some of the recurring capex if we're on selection of finishes and and the likes. So anyway, I won't go more into that, but to me, why green? Why ESG? It's just because it makes sense. At the end of the day, it makes economic and it just makes sense. You can't dispute it.
And as we're getting older, when we have grandkids, we want them to live in a planet that is better than where we started, right?
That's what we want. As Tessa Pang said, the numbers and the sustainability approach make sense. And I think that's the nice thing is that it not only makes sense for the planet, but it makes sense financially, and therefore it's a win-win in terms of the process. Guys, I mean, you're on the ground, Paul. You're on the ground in Brisbane. Investors do want to know about, particularly if you're not from Australia, about the floods, etc. I don't tend to want to take too much time on this because what I've said is we all have to do our part in terms of making the planet greener and better because this is all a consequence of the way we've been living. But what's been happening with the floods and then what we're going to do from the floods is I actually want to pivot, David, into your talking around Chermside and what's happening in that area, because obviously the floods, we could spend half an hour talking about the floods and I'm not really interested in that. I'm interested in talking about the sector we're in, the site we're in and whether it's impacted by the floods. Paul, what's happening on the ground there?
Yeah, well, I guess one of the main things people think about is my property safe? And, and if your property's safe, you actually don't think a lot more about it. Like in some places in Australia, whole towns have gone under. But the area where this particular building is flood free, and at the moment in Brisbane, everybody's clamoring around for rental accommodation or somewhere to live. One guy rents out containers for people to sleep and live in, and the insurance companies are paying $1,000 a week for temporary container homes to be dropped down in people's backyard until they get their houses right. So, all this means having something in Kensington that's flood-free, that's able to accommodate people in the future in the renting market, and everything that people have said tonight means that in many ways the floods are irrelevant as a building, but in terms of how it affects the potential for this building is enormous.
Perfect. And yeah, David, if we could pivot to you in terms of Chermside in general, because you had some amazing stats earlier around what's happening with the hospital, etc. Because again, if you've noticed today, we've gone why Australia, why Brisbane, and now it's down to actually the suburb and what's happening in the suburb. And it's really important as an investor to look at long-term trends if one's wanting to have a favorable long-term outcome.
Yeah, no, thanks for that, Scott. Look, I'll just try and get this up, fit the window. I'll have to zoom in. Actually, I'll see if I can get this up. Am I able to share? Yeah, if you can stop sharing for a minute. Again, just bear with me. I'll just get this up. So again, I'll have to zoom in. That's not going to do it.
So we.
Sorry about this. So, well, see if I can get it bigger. So Chermside, which is actually the suburb within Brisbane that the property that the co-living property is that we're actually doing. Is that big enough for you guys to see, by the way?
I think so.
I'm trying. It's basically, this is a bird's eye view of the site, and I just wanted to talk through what's around it and its proximity, if you like. So you can see it sits. The site sits basically almost equidistant. It's about 300 to 400 metres to what they call Westfield Chermside, which is the largest Westfield shopping centre in the southern hemisphere, and it's about 400 metres in the other direction to Prince Charles Hospital, which is the largest hospital in Queensland, not just in Brisbane, but in Queensland. It's also about 9.5 k's to the CBD, and in this direction over that way, it's about 13 k's to the airport, and in that direction that way, it's about 10 k's to Moreton Bay. And as you can see, it's plenty of parkland, etc. around and facilities. There's also plenty of secondary schools and primary schools. What's also in close proximity to the hospital, which this is a big public hospital. There is I'll show you in a second, there's actually some plans that the government is actually currently in. They're already working on it. They're going to double the size of this hospital. Whilst it's the largest hospital, they're going to even double the size of it. It's going to go from a 630-bed acute public hospital with 3,500 staff. They're effectively going to double the size of that between now and 2030. Also, what's...
And the funding's already been set aside, hasn't it, David?
Yeah, it's actually has been set aside, and they're actually implementing it all. So that's really what's going on at the moment. I'll go to it.
So it will be the major employer. It'll be the major employer in the area, won't it, with about 8,000 staff.
Yeah, that's it. So you can see here, this is effectively the hospital site. The hospital site, what it looks like in 2020, and this is the modelling for what it's going to look like in 2030. And our site is literally just down here. So as it says here, the key thing is it's also near. It's not just that hospital; it's then the ancillary stuff that's nearby, and that ancillary stuff is other private hospitals, private. There's a St Vincent private hospital, there's Chermside Medical Complex, there's a day hospital at Chermside, there's the University of Queensland Northside Clinical School, there's the Queensland Institute of Technology as well. So look, we're as far as being positioned well, we're right near key workers and young key workers that need accommodation and that will be looking for the type of accommodation that we have within the co-living. So that's it's an absolute a critical reason why we've located it and the type of accommodation that we're looking to have there.
And in that nursing fraternity, we get a lot of overseas nurses, don't we? They're coming in on 3-year contracts.
Yeah, very much so. Very much so, Jason. And so they're coming in from overseas. They don't know anybody, but they can turn up there, and all of a sudden they can live in an area where and in a facility whereby there's a community, and they can join into the activities. They can break out from where they're living and not just be in a little apartment on their own. They can break out and go co-working, or they can go do yoga with somebody, or there's actually socialising spaces, or go and cook up in the communal kitchen, or go and hang out in the cafe, or go up into the swimming pool. So there's actually, it creates a great lifestyle. And with the green side of it, we're very much trying to make it as feeling like an oasis of a place to live in Chermside for our guests. We call them guests rather than tenants.
Yeah. So Scott, what we've found in the co-living communities is basically that's what it is. It fast tracks people to creating community, creating friendships, and creating a lifestyle. So some of the key drivers for.
Yeah, and it also provides flexibility. I know Jason's talked about this before, but it provides flexibility. So somebody might rock up and they think that they're going to be there for 3 years, but then they get another secondment up to somewhere else, and so they've got to leave in 3 months. Well, they're not locked into any lease or anything. So if that's what they need to do, that's what they need to do. And so there's flexibility. They don't have to buy the refrigerator. They don't have to buy the furniture and set it all up. My son just moved up to Brisbane or up to the Gold Coast not long ago, and had to set everything up. And 6 months later, he's moved on to the next spot, and he sold everything before he's moved on. And it's just this just is the key thing for flexibility. It allows people an affordable way to live, a flexible way to live, and there's community.
And from an operating perspective, Scott, everything we're doing now is app driven. So when the tenant is onboarded, they actually goes through their phone. So their phone can open through a QR code their door. They have a connective app. Within the app, there's another app about the community. They can connect within the community. They can be in the workplace zone. If they don't want to be disturbed, they can have a silent notice on. If they don't mind being disturbed for a coffee, they can put a coffee notice on. And it also helps us run. We're putting things within the building like a flow rate. So we attach each room has a flow rate. So we know if they're leaving their water on or if their toilet's leaking, we can go in and fix it because we can check how much water is being lost. Same with power. If somebody's in there doing Bitcoin mining and using a lot of electricity, we know we can shut it down, So but all those things are effective in running a building effectively, cost effectively, and creating a higher return for the investor, right? So we create a great community where people want to live, but also the other thing is it's a great investment for the investor because they make more money because their costs are lower. It
makes me think, we all have smartphones, smart watches. You're talking about smart living, and now we're telling people how to do smart investing. So it's.
Well, the interesting thing is, I think Paul knows a bit about that smart investing, where the future is going to go.
Exactly. Just before we go to Paul, because that's my last question. My second last question, David. I got asked a question last week about Ukraine and building costs, and and everything else. And you've been actually running through an exercise at the moment just to make sure that the feasibility studies, etc., still make sense. Do you want to just talk to that? And then, Paul, we're going to pivot to you about the future and where things are going with tokenization, etc.
Yes, certainly. Look, we, as part of what we're doing, and because it is an emerging asset class, we're very, very aware to be able to put an exceedingly robust business case together. We did that last year with a business case that was put together in May, June last year. However, the market, since that time, the market has moved with the pandemic. We've had an increase in construction costs, which is well above what our normal escalation rates are. We've also had increases in, at the same time though, we've also had increases in gross realizations or selling prices, but also rents. So what we've done is totally up. We're in the process of just finalising it, but we've totally updated our business case, which is basically we have our quantity surveyor Mitchell Brantman has put together the construction numbers, and we're getting price coverage from a builder at the moment with regards to those construction prices. So they've been updated from what we had from early last year. And then on top of that, our demographic and economics report, we've had Think Economics update their economic report, which effectively confirms off where things have moved, because there has been a change in migration and an increase in migration. So and also on where rents are. So, and the rents have effectively gone up from, by 25% is where it is. At the same time, construction costs have gone up by 20%. So one is offsetting the other. And then we've got Urbis, who is a very large company over here who's done the valuation. And I've had them update their numbers with regards to the valuation. And we're now just finalising and socialising things with the banks to confirm off on lending parameters. So to cut through it all, we put all that together and we end up with a very robust feasibility model. It's really where, and commercial assessment of where it's coming out. And so, yes, Scott, we've just been through that whole process, and it's all looking good.
Brilliant. Paul, I see my battery charger is not working, so I'm going to run and get my cable. But while I'm doing that, can you talk to us about the future tokenization and why this asset class actually plays into the future?
Yeah, I'll do that, Scott. Some of you know my background, but I've done over 300 capital raises for about 160 million. And one of the things you learn along this, that community is really, really important. And whether it's a capital raise that's for units or shares or whatever, or it's for tokens, digital tokens and things like that, in reality, they just determine how you break up the property. But what is important is that the community is there to raise the money. And a lot of people think, oh, this is a beautiful token, it's this and that. In reality, you need the community. And the great thing about co-living, and what excites me, especially with the fact that this fits into a portfolio of 5 or 6 properties, and you sort of think all those tenants, all those people, all those investors are a community. And that community is what you need if you're going to tokenize a building. And so in the future, I can see, like, my belief is every asset in the world will be tokenized within the next, maybe 7 or 8 years. Now, that's a bit far out, it's a lot longer out, but it just shows you where things are heading, because investment evidenced on the blockchain, where people can just zoom in, they can see what they own, they can check directly to the land registry, and that is where things are going. So co-living, bundles of co-living properties, all the people associated with is a wonderful, wonderful community to be able to issue tokens, and also NFTs. If you're an owner of an NFT that's a co-living NFT, then you maybe can go from building to building around the world or whatever. Who knows what the future is? But I think it's a great place to start, a great asset to do that, Scott.
Paul, one of the things that always intrigues me as well is that if your tenants were, as part of their rent, were actually buying a piece of the building at the same time, you would actually, you'd have them a lot more attached to the asset. They would, they'd behave more like owners, everything else. And again, it's not possible with a traditional model, but it is with tokenization and fractionalization, so.
Well, absolutely. Actually, I might patent that idea. I think that's a bloody good idea.
I'm sorry. I think I'd just like to have it on record that came from me. Just by the way, I will actually send you a report. There's already a company doing that in America in multifamily, and the statistics already prove that not only do tenants want to stay there, because now they're not just tenants, they're starting to get, they're becoming an investor as well. But also, as I said to you already, it gives an owner-occupier mindset versus a tenant mindset. So it is interesting. As I'm conscious of time, we're on the hour. And I just want to rock and roll here. Someone said, Sonia said, how long will the investments be locked in for? You've got an investment for 4 years at the moment in terms of the asset. I'm happy to stay on and answer any questions that anyone has. I did do a webinar last week on diversification. It's really important that when you're looking at a new asset class, a country, a city, and everything we've discussed, you can look at diversification and not being stuck in one country or one asset class. And I explained to you the benefits, and you can see here the purple, the benefits of co-living. So you've got the co-living option, you've got a diversified option, you've got the option of just buying an apartment in London, leaving your money in the bank, and or investing like in just one asset class, say in America in one asset class. So don't, I always joke with people, don't shoot the messenger, it's facts. A lot of investors get caught up in sentiment. I like to look at models and data and ultimately look at the results. So in conclusion, Australia is one of the top performing economies post-COVID. Brisbane is the top market and including the Olympics. Affordability is a key issue. First-time home buyers are reducing due to affordability, which basically means they're becoming tenants. Interest rates are expected to rise, although I showed you already that they're on hold at the moment, but as they do, it will drive rentals. Densification is a major trend. The bottom 25% of the market is the most stable, so that's below 500,000. Increase in rentals is going to continue as borders open. Green investing is a massive trend for the future, and by the way, it's not just good for the planet, but as we've shown you that it actually economically makes sense. And then co-living is a massive trend for the future. And if you're interested in following these trends and participating in these trends, you can literally go on the Wealth Migrate platform and you can invest from $100. So anyone that's on this webinar literally has access. By the way, we've got investors that invest north of $1 million. So it's not only $100 investors, it just allows everyone to be able to participate. And you can see here, you're looking at an internal rate of return of roughly 15%. And if you want me to come back, I can show you how on the platform. It just gives you an idea of what you can look at. And the part that I like most when one's looking at an exit strategy, and this is where the team from 6C are so valuable, is that it's not one opportunity just in Brisbane. One of the exit strategies is that 6C is actually working, and David already mentioned it, on building a portfolio of co-living projects around Australia. And what you do is that although we, and I use the word we because I've personally invested in this deal, we would own this deal specifically, the opportunity to exit would be amalgamating these assets and being able to sell them on as a diversified portfolio to an institutional investor. So whether that's through tokenization, Paul, or the more traditional, institutional route, but it is nice to know that you're not just one building in isolation in one market. You're with a partner in 6C that is doing it at scale and diversity in terms of the overall. So in conclusion, if you are interested, reach out to us, go to the Wealth Migrate platform. You can invest directly. If you've come from Asia or Property News Asia and want to deal with Alex, unfortunately, his mother is not well at the moment, so he wasn't able to join us on this webinar. That is his QR code. You can, connect with him directly. If you want to reach out to Jason, David, Paul, or myself, just reach out to the team at invest@wealthmigrate.com and we will be happy to help you. And I think the closing comments, and I'm just conscious of people's time, no matter where you are in the world, I think the closing comments that I like is that what we've looked at in this overall webinar is we've looked at co-living and the sector and the trends of co-living. We've looked at green and the importance of green. We've looked at diversification and the benefits of diversification in comparison with just buying an apartment in London. And finally, today, we've looked at why Australia, why Brisbane, and even down to why Chermside and why this opportunity. And so I want to kind of put it to the floor, Jason, David, and Paul, just for closing comments. It's been a 4-week series. It's been a huge amount of information. People, I would highly recommend they watch the other webinars as well. But just closing comments on kind of where you're at, where you see the market going, and why you're involved in this project.
David, you can go first. I'll go after you.
Okay, so why this project? Why this project? It's a great project. We're very passionate about co-living. We're very passionate about green. We're very passionate about making this stuff work. And we're been very focused and working on affordable housing and affordable housing solutions for a long time. So it's something that's very dear to the heart. Is really it for me. And I'm looking forward to being able to put a number of these together and setting a benchmark for the industry, for people to be able to judge themselves by, is really what it comes down to. And creating great homes for people to live in.
So for myself, I've been in the property sector since the early 90s, from agency, working some of the big firms, for doing my own developments, working for development companies. I've worked across many sectors, commercial, residential. And what I see in this class is two things. One, we're creating a great environment for people to live, to create friendships, to create working hubs, to do so many things that are going to be influential in their lives, which is really important. And the second thing is the financial. We're doing a development. We're making profit from development. And what we're going to do is create a portfolio. And what that portfolio does is, for the initial investors who get in, they can go from where they would sell their normal asset at, say, a 5% or 5.25% yield. They'll end up compressing that down to, say, a 4.5%, 4.25% yield, which is a massive increase in asset value. So what we do is we create good communities, and we also create good developments, and that's something that really drives me. I like the idea of creating this whole portfolio and seeing the realization of it when we exit at the end to a super fund or, some sovereign fund. It's really exciting, and I think we're going to see a lot of news about it when people start living there,
That's Paul here. It's just like I was passionate about fractionalization. The second video or set webinar we did was just amazing. You're close to a project like this, like me, every day you're doing things to do with Kensington mortgages and things like that. But after that second one on the green, the sustainability, I got so bloody excited about it. I thought, shit, what? Every building has to be built like this. It was just so logical. And you sort of think, it's as if we're getting a glimpse of the future here of where things are going. And just like Scott said, 10 years ago, there's a medical thing, and way back then it was, it was unique, and it was a smart and a great strategy that was adopted. You get the feeling that this is another one of those things that's going to ride a wave for 8 or 10 years, where people suddenly realize that green, sustainable buildings and co-living and all of this that's been discussed in these 4 videos is where the investment world is going in property. So that's what excites me. And I see you nodding your head, Jason, and you've been around a lot longer than me in the property area, and so it's exciting. So thanks, Scott, for being such a wonderful leader on this call, and I'll hand back to you.
No, awesome. Well, thank you to all 3 of you. There's a question here from Iona. What do you think the apartment market in Australia? Which city is still good to go for overseas investors?
Okay, can I answer this? Can I answer this?
Go for it.
It's okay. Just recently, in this last week, there was a big push that finally, since COVID, apartments are now going to outperform houses. So this year, 2022, is the year that apartments will outperform houses in price growth. So I think anywhere you buy at the moment, and as you're a foreign investor, you can only buy new properties, right? You can't buy second-hand properties here in Australia. And you do pay a little bit of extra stamp duty for a residential apartment, but anywhere your money can afford is where you should buy. So if you can't afford Sydney, you can afford Brisbane, buy Brisbane, right? Because there is a big difference in the gap, I think Brisbane, out of Sydney, Melbourne, and Brisbane probably has the more upside in the fact of there's more people moving there. You've got better access to tenants. It actually has a lower vacancy at the moment than Sydney and Melbourne. It's only about 1% vacancy across the board. And I can see capital growth going up there with the Olympics with people transmigrating for work. And I think it has a good story and it's more affordable. So I think it's, Sydney at the moment is peaking, and it's going to plateau. Melbourne is going to take off. It's going to have a good increase. But I think Brisbane will have the most increase of the three major cities.
And I think just to that point, for all the reasons that we've been discussing, if you want to go on a platform and literally invest, I'm not going to go through all the details, but you can literally go in from $97. You can go continue. I literally digitally sign my agreements. I can obviously go and download them all. I go agree. I go make investment. And for the person asking the question, if you want to fly to Australia and go and set up structures and bank accounts and go through all the hassle of getting a mortgage, then go for it. Or you could just invest online like I've just shown you in 30 seconds. So
I just wish we could have this tokenized, Scott, and I'd be straight in, huh?
Well, what's interesting, Jason, is that we actually are tokenized at the moment. And let me be very clear on that just quickly, is that we've effectively tokenized on the US dollar at the moment. So it's really based on the principle of tokenization and fractionalization, and it's based on a $1. With time though, and obviously the intention, we were actually the very first, and Paul and I were part of this. We were the very first platform in the world, property platform, to go on the blockchain in 2016. The problem is that and I don't want to detract and derail this webinar, but there's a whole thing about regulation and what you can and can't do, and kind of the old world and the new world. But my point being is that, this is where the world's going. I mean, I completely agree with everything Paul said, but people don't have to wait. I mean, they can literally participate from today, in terms of getting access, and I think it's probably a good way to end off where, Iona said, yeah, thanks, Jason, because I have clients, investors who are looking for AU again, and Queen's Wharf now driving huge attention. So Iona, reach out to one of the team members or to Alex, and we'd be happy to assist you with helping you. And I think it's a good way to end off with, we've been talking about smart living. We ultimately are trying to help everyone with smart investing. And so that's it from all of us. Property 5.0 has been a really interesting, and I do acknowledge what Paul said. I've learned an absolute huge amount on these webinars. So really thank you to Jason and David and the guests that you've invited. They really have been phenomenal. I do highly recommend that people go and watch the recordings. And most importantly, I am proud to be an investor in this project, to be an investor with 6C. And I look forward to riding the co-living wave, certainly over the next decade, but for who knows how long. Thank you, everyone.